The broadcast is now starting. All attendees are in listen-only mode.
Good morning and welcome to the Texas Mortgage Bankers Association 2022-23 Education Webinar Series, a part of the Education and Endowment Committee this year led by Pam Jenkins and David Tagenbaugh. I'm Marty Green and I'll be moderating today's webinar. The webinar should take about an hour. Feel free to ask any questions throughout the webinar using the chat or questions window. As always, if you have additional questions, you can email Carol at the email address on the slide. Today we have a very illustrious panel. I'm very pleased to have them with us. The first person that we have is Troy Garris of Garris Horn. We have Russell Pulliam with First Bank Texas, and Heather Palomo of Central Bank in Houston. First, I want to introduce Troy. Troy is the man with the hat, as many of you know. He's a business owner's lawyer. He prides himself on a results-oriented, pragmatic approach to legal issues in the financial services arena. He deals with federal and state compliance and enforcement defense issues, including fair lending, which is what we'll be talking about today. He represents a wide variety of independent mortgage bankers, banks, and similarly related entities. Welcome, Troy. We're very happy to have a real lawyer on the panel today. Second person we have is Russell Pulliam. He is Executive Vice President of Mortgage at First Bank Texas, and he believes that if he helps enough people get what they want in life, he will get what he wants out of life. He began his career in mortgage back in 1999. He's owned a mortgage company with 3 partners. He's overseen the mortgage department for banks during this time period as well. Russell loves our industry, loves what he does, loves the teams and the people that he's been fortunate enough to work with, and the customers and referral partners that he's been able to serve. One interesting fact about Russell is that he lived in a treehouse for almost a year. So make sure when you see Russell at the next TMBA event in the bar that you get greater details with respect to that, because I think it might be a very, very interesting story. And then our last panelist today is Heather Palomo. She began her career in the mortgage lending industry about 24 years ago at Chase Manhattan Bank. She's been recognized as Central Bank's Senior Vice President for Mortgage Lending Manager since 2019. As Houston's longest serving independent bank, she represents her team by focusing on expanding into the secondary market and diversifying its products to match its borrowers' needs. As a leader in the industry, Ms. Palomo enjoys sharing her experience and educating her employees in advocacy work for the mortgage industry. Thanks, Heather. It's a pleasure meeting you and having you join our panel today as we talk about fair lending. I'm Marty Green of Polonsky Bottle Green. I've been in the financial services industry for over 30 years. I advise clients on the latest rules and regulations and everything revolving residential mortgage lending, in addition to assisting them with their loan documentation needs. I'm also currently serving as a member of the Texas Finance Commission, which oversees the Texas Department of Savings and Mortgage Lending, the Texas Department of Banking, and the Office of Consumer Credit Commissioner. So let's get started today. We're talking today about the CRA, the Community Reinvestment Act, and fair lending laws. So first, I'd like to kind of put those 2 topics in context because I sometimes think they get conflated. And that's kind of, let's talk about what really is fair lending. And then secondly, how does the Community Reinvestment Act fit in with the fair lending as it relates to the mortgage industry? Carol, could you put up the first slide there? I think it kind of has some discussion of fair lending laws. And I'd kind of like to turn it just briefly over to Troy for him to kind of outline the Community Reinvestment Act and the fair lending laws a little bit and put these 2 concepts into context. So Troy, I'm going to turn it over to you for a moment.
Yeah, thanks, Marty. Thanks for the introduction. I'm happy everybody is here, and thanks for especially my co-panelists and yourself, Marty, and the TMBA. TMBA is a fantastic organization, and I encourage everybody that isn't a member to become one and get your people involved too. We're talking a lot about that these days. So with regard to the Community Reinvestment Act, what I'll call it the CRA, and fair lending laws, they really are focused on similar problems, but they come at it from different angles. And they were both written back, 30, 40 years ago, and actually even longer now. And they apply to different types of institutions. Everything we're going to talk about today, first of all, is going to be at the federal level because there are some state level requirements. We just won't have time to dive into all of that. But there are these mini fair lending laws out there, and there's some regulators that get involved as well at the state level. But all of these apply to depository institutions. And so any bank or any credit union has to wrestle with how to best comply with these. And the fair lending laws, which is just kind of an amalgamation of some different laws. There's no one called fair lending law, but it's a group of laws. They apply to independent mortgage banking companies, so the licensed people that are members of the Texas MBA and their friends. But the CRA requirements don't specifically apply to non-depositories. And so that's one critical difference. I will say that a lot of the ideas do, in fact, bleed into each other. And we'll talk about this a little bit, but some of the ideas about how to comply with CRA, just conceptually, it's not specific loan level type questions that might come up that I think Heather and Russell are going to talk to a little bit, but just the concepts themselves sometimes can help shed some light into how people might try to comply with fair lending laws generally. So let me give just a snapshot about CRA, and this slide is pretty helpful. Everyone will have a copy of this at the end, and so it's a good takeaway to keep sort of in your desk drawer or in your files to refer back to. But the CRA mostly focuses on, I'm super high level here, mostly focuses on low to moderate income individuals and areas, businesses and farms. And again, this is the idea is that the overarching idea is that if a bank or a depository institution is in a particular community and getting deposits from that community, then the bank has some moral and legal obligation to invest into that community. The concept was from Congress, we don't want people taking the deposits from community one and then making a bunch of loans in community two, but leaving community one behind. Right. Go ahead, Mike.
Yeah, I was just going to say, just sort of when I sort of think about this, I think of the fair lending laws as kind of being a very broad umbrella of, as you say, an amalgamation of different laws that are intended to make sure that people are treated fairly. And the way I don't know if this is true or not, but when you look back at historically, the Community Reinvestment Act was really designed to kind of combat redlining, where you did have certain banks that would just not lend in certain areas, even though they were taking deposits from that. And so it's kind of, to me, more of a measuring stick as well to ensure that they are serving those communities. So it's just one sort of way of looking at it, but the broader fair lending laws is much broader, applies to all of the legal entities, including banks, depositories, and then non-depository independent mortgage companies. But the Community Reinvestment Act is a measuring stick that just applies to depositories, as I kind of see it. Russ and Heather, what are y'all's thoughts in terms of the interplay of the fair lending laws and the Community Reinvestment Act? How do you see it from your end?
So from a community bank perspective, we do a lot of work in this space in both, right? So we have CRA requirements, and I know you're talking about fair lending, but in the community banking space, we call it majority minority lending, which just simply means that the majority of that census tract is a minority, either Black, Hispanic, or Asian. Versus CRA, which is low to moderate income. Now the two can intertwine and overlap with each other, but they're two kind of separate topics. One major difference between the two is on the fair lending side of things for majority minority. Those loans have to be organically originated by the lender, so it has to close and fund in the lender's name, versus CRA, which is more of a affordability, low to moderate income. Banks can actually buy those loans and service them and still get credit. So I think it's definitely important that we continue our marketing efforts to increase our loan production in those underserved communities, and that we continue doing work to promote affordable home ownership.
I agree. It's great work with respect to that. Russell, what about from your perspective, what do you see as the principal distinctions between just fair lending in a general sense versus the CRA as it applies to your depository institution?
So for me, I think fair lending is in the most simplistic form is it's just making sure that the lending opportunity is fair for everybody across the board and the same. You know, I think Troy mentioned it a little bit earlier, but LMI, I mean, if there's a benefit that we're receiving from a community or neighborhood, then we have an obligation, even one could argue morally, to make sure that you're lending in those areas as well, and serving that community. So, you know, if you're getting benefit from a neighborhood or community, you need to be sure to benefit and come back and share.
So CRA focuses more communities you serve, and fair lending may involve as much as anything the people you serve, if you will, kind of looking at it that way.
Yes.
Troy, in terms of just that overall fair lending umbrella of the laws that are applicable, I know ECOA, the Equal Credit Opportunity Act, is right at the forefront of those. When you look at how the regulators today are sort of looking at fair lending, is that where you see their focus, or do you see their focus in some of the other, you know, you said the amalgamation of other laws? Are there other laws besides ECOA that you think are also focal points of what they're looking at when they're trying to ferret out fair lending violations?
Yeah, it's a great point, Marty. And so the places we are seeing this really are on the ECOA front by the CFPB and on the Fair Housing Act front by HUD and DOJ. And to some degree, there's coordination and interaction between those different groups. The CFPB will sometimes have the DOJ involved in some of its actions, and HUD doesn't bring its own cases, so the DOJ gets involved if there's a Fair Housing Act enforcement action. And so they do operate separately and then also together. And there's a lot of cross-pollination. There's a lot of coordination, because even with the enormous resources of DOJ and HUD and CFPB, they can't go after everybody. And so they try not to duplicate. But I think it's those two mostly. There are others out there, advocacy groups and the like. The new HMDA data is providing a lot of information for people that, you know, are just sort of trolling around looking for problems to try to take a look at and see if people are operating correctly.
Is it information or is it ammunition? That's the question, right? I mean,
I think it's both, and I think it actually helps both sides. Data is powerful, and you know, people read into it what they want to a lot of times, for better and worse.
Right.
But I think it is both. Yeah.
Interesting. Well, Russell, I'm going to circle back to you just for a second. I kind of want to get your thoughts on what you think the fundamental elements of a fair lending sort of policy and procedure and for your organization would look like, or does look like, kind of in terms of the guardrails that you think are really important that y'all put in place just to ensure fair lending is at the forefront of your organization's operations there.
Sure, Marty. So, you know, for us, the fundamentals of policies and procedures in this area, you know, they need to be revolving around ensuring fair and equitable, non-discriminatory lending. The guardrails that kind of surround that should include clearly stated non-discriminatory policies, regular training and education. We're really big on the training portion of that, and education, risk assessment, monitoring. You know, our business has so much data collecting, so we collect all that data, and not only do we collect the data, but you got to analyze the data as well, right? And so the next step would be underwriting and approval process, and you got to monitor that periodically to make sure that you're consistent and that you're not finding any gaps in those. And then for us, the last thing, which is a big thing, is marketing and outreach playbook. We put a playbook together, you know, the end of the third quarter, beginning of the fourth quarter, as far as our marketing and outreach. And then we hold ourselves accountable to that playbook. And then if an auditor examiner comes in, we're able to show, hey, this was our playbook, and these are the things that we followed through on, and this gave us success, and here's our opportunities for next year.
Those are great points. Heather, on your organization, what do you see there that's also in terms of that kind of guardrails that y'all put into place, and how do you view your implementation of your fair lending policies in terms of what's most important?
So we, in terms of our policies and procedures, we create a lot of awareness for our employees. There's required training for our employees because it really starts there, right? With the staff and making sure that they're educated and creating that fair lending awareness to make sure that we are practicing non-discriminatory behaviors. You know, we put a lot of stock in, you know, making sure that, you know, there's no disparate treatment, disparate impact, etc. And, you know, as things change, because compliance is constantly evolving, just for an example, we changed our air policy last year because of the study that Fannie Mae and Freddie Mac did with appraisal bias. So we had to go to all of our, you know, AMCs and say, hey, you know, what are your policies and procedures around this? Because when you use an AMC, obviously you don't have any direct contact with that appraiser. You don't even know who it is until the appraisal is done. So we wanted to make sure that we had safeguards in place as well for our vendors.
That's great. That's great policy. Y'all both mentioned training, and that's obviously an important aspect of a fair lending protocol. What do you think is the right sort of intervals for requiring that? Do y'all do it on an annual basis, on a biannual basis, more frequently than that? I know banks are more regimented about this than certainly non-banks tend to be, but I'm just curious what y'all's thoughts are on that, about the frequency of it.
So for us, before a team member can even start, you know, doing their normal daily role activities, we require training front, and that training does include extensive fair lending training. Now, it may be not specifically saying fair lending, but it will certainly address those areas.
That's great.
And then, of course, just periodic throughout the year.
Okay. Heather, how often do y'all require people to go through the fair lending training formalized?
So like Russell's Bank, during the onboarding process, we new hires are required to take fair lending training, and annually all employees are required to take it. So even after you're hired, you have to take, it's between 4 and 5 classes specifically for fair lending that we're taking per year. Plus, you know, if additional issues arise, then we're doing additional training on top of that as it's industry specific, like the air policy.
That's terrific. I will tell you that I recently represented a depository institution that had a discrimination complaint. And one of the things that the regulator who was doing the investigation was very impressed with was the number of times that every single person that the borrower or consumer had identified had participated in the transaction. Every single one of them had been through a fair lending training recently and multiple times. So that was something that was very important to them in terms of making a no-cause determination. One of the other things that I thought was interesting about it is that we had the good fortune in that particular instance of having recently updated during the time this particular borrower, the bank had assisted over a 2-year period with multiple applications. And what was interesting about it is during that time frame, they had actually updated the fair lending policy. So we ended up, as part of the process, providing them with both copies of that. But that actually was very beneficial to us because it showed to the regulator that fair lending was very much at the forefront of the lender's thoughts in terms of updating that, because the worst thing that could happen is that you're presenting them with your fair lending policy and it's dated 2003 or something like that. Right. So I think a frequent revisiting of that is important, even if you don't make some material changes. If nothing else, update the date on it because it shows you looked at it. So I think that's important. Clearly, as banks, y'all have done a great job in terms of establishing that. One of the things you indicated is how do you ferret out biases? So I'm just curious as to what you think is important in terms of a process to make sure you're properly assessing and addressing any kind of potential bias in your policies to ensure fair lending for all borrowers. And one area I'd like to get your thoughts specifically about is underwriting is obviously an area that requires a certain amount of application on an even basis, but it also has perhaps a little bit more of an opinion of the person of certainly making those judgment calls. So how do you, when you have multiple underwriters, balance your fair lending obligations with also giving them sufficient sort of latitude to make those kind of judgment calls that are also important to you as a lender. So Russell, I'm going to let you start with that, and then I'll let Heather follow up if that works.
Well, Marty, you're absolutely correct. There is objectivity, and underwriters are typically the first ones that will remind you of that objectivity too. But what we do is, again, going back to data, there's all kinds of data that's available in our industry, and we pull data. And in cases where you're fortunate to have multiple underwriters, you pull it. Just take adverse action for as one example. You can pull all of your adverse action, especially as it relates to the denial section. Leave out the underwriter, and then go check the files and make sure that they're consistency without knowing who the underwriter is at all. And so then you can compare those decisions across all boards and making sure that your underwriting staff is underwriting in a consistent, fair manner. And then if you start seeing some reoccurring reasonings for denials, and again, just using adverse action as one example, then you can start saying, okay, is this particular underwriter having some reoccurring reasons for that, or is it across the board? And that way you can kind of do the proper analysis to address any potential issues that you see.
Heather, what about you? What are your thoughts on that? How do you manage the underwriting process to ensure that everyone's being dealt with in an even-handed sort of way?
I would say 99.9% of our loans, I'm sending them through pre-funding quality control and post-closing quality control. It costs the bank a little bit more, but it also protects us as well. And that helps address any potential underwriting issues if we see the same issues popping up. Especially those loans that we're selling on the secondary market, we're primarily using our investors to underwrite those loans given the circumstances of the industry right now. And so, sometimes I even have to cross-check, one of our investors and say, hey, get with the investor, this particular underwriter's done this on this transaction. Can we have a conversation about this?
What about in terms of the assignment of files to underwriting? Do you make sure that they have a cross-section of them so that they are serving multiple communities, or are they more branch specific or in terms of how they are assigned files?
Right. So we have centralized lending depending on, what that product's going to do. Is it going in my portfolio and I'm going to service it, or am I selling it on the secondary market? And that's kind of how the assignment goes. We're a pretty small bank. There's only 10 people total underneath me. So, I got 2 underwriters, a couple of processors, and a few salespeople.
Russell, what about you in terms of the assignment process on underwriters? If you have multiple ones, do you have any tips that you have in terms of mitigating any fair lending concerns?
Sure, Marty. So we do a round robin so that, it's just, by chance and not specific. It is a little bit different because we're not a large institution, much like Heather, as it relates to FHA and VA. So you have a limited amount of underwriters that have their D or LAP. So that does provide a little bit more challenge, but we can utilize our data partners to help us in assessing that, either from, like Heather mentioned earlier, pre-funding or post-closing to kind of monitor and manage that as well.
Right. Well, I'm going to shift a little bit to talk a little bit about just some of the recent redlining cases, and I want to get some Troy's thoughts on that because he's involved in one of them. Redlining, as we said, is where lenders historically, way back in the day, would just simply not lend in certain areas, and so there's laws that were put into place, and certainly the CRA is one of those that's intended to combat that. There's 3 recent cases. One involved Trustmark, which is a depository. One involved Trident Mortgage, which is a realtor-affiliated independent mortgage banker, and then one involved a small independent mortgage banker up in Chicago, Townstone. And I know, Troy, your firm was involved in the Townstone case, and you were actually won that case, so congratulations on that. I know there's still some appeals pending with respect to that, but that was one where the industry actually won, so that's very helpful. But I wanted to get your thoughts on how you see this trend of cases, because I remember for a long time there wasn't a whole lot out there on the redlining front, and now there has been this kind of cadence of them coming through. So I wanted to get your thoughts on the trend of cases and what you suggest lenders might do on a fair lending basis to kind of reduce their risks with respect to redlining theories of liability.
Yeah, thanks, Marty. And those three cases that you mentioned actually are probably a great touch point for the types of things that people can try to do to help themselves in this regard. With the depository institutions, there's always been this concept of redlining that the depository institutions had to be very careful about. And over the years, a lot of years now, there have been a number of settlements, most of these cases settle, of course, just like in every other context. Most of these cases settle, and the allegations often had interrelated to Community Reinvestment Act obligations and the Fair Housing Act, mostly, occasionally on the ECOA end. And usually they're involving DOJ historically. But and we, of course, have different views from a lot of times what the government lawyers will take the positions on in terms of what the obligations are and what the risks are and so on, and the facts even. But leaving the legalities aside for a moment and focusing on what the lenders, whether it's an IMB or whether it's a bank or a depository institution, can do to help itself, I think what the regulators are looking for are kind of spelled out in the consent orders that both Trustmark and Trident have. Now, Townstone, like you mentioned, Marty, is still pending in the court, the federal courts in Chicago. In fact, we filed a brief just this week, the appellee's brief in that decision that's now up on the Seventh Circuit. So that one's still pending out there, but the other two are consent orders. And I think if you look into the guts of those consent orders, or even just the press releases, you can see what the regulators are trying to get people to do in terms of helping protect themselves. I personally think it creates different kinds of risks for if you follow what the regulators are trying to do. In fact, I think what the regulators are trying to do creates itself a lot of legal problems. But if you just think about what are my regulators expecting of me, you can see, I think, what that is in some of these cases. So, for example, they talk about marketing. Are you marketing into specific areas? A lot of times they're thinking about the M&M areas that Heather mentioned a little earlier, the majority minority areas. Are you taking actions to specifically identify and then go into those markets and try to reach borrowers there? So, and that's in their minds kind of a toggle. It's a yes or no kind of a question. Similarly, are you making hiring decisions based on people that, in their view, in the regulator's view, would get you access to these types of communities? And that could be a lot of different things. I think it creates a lot of employment law risk and so on, because it's almost like the government is forcing people to take into account race or ethnicity, et cetera, whenever they're hiring, which is itself a problem and is starting to create a lot of controversy and problems there. But I do think that there are ways to sort of slalom between those poles, because if you just, instead of thinking about, hey, there's a, pick the category, it doesn't really matter. I'm gonna go in, there's this particular minority area, I'm going to purposely go in there and focus on that. Instead of doing that, if you just say, look, especially on the independent side, I'm a mortgage banking company, and if I don't make a loan, I don't make any money. Like, I'm out of business. If you just think about, how do I cast my net as wide as possible, whatever that means, and get my people to go everywhere and anywhere to try to find loans, because we can help communities and we can help ourselves while doing good. I think that sort of gets you a lot of what the regulators are looking for in these cases, and then also it helps your business in a way that, you know, helps you solve for two issues of making money and also helping people and staving off regulators.
Yeah, those are all great points. One of the things that seemed to me those cases seemed to focus on, which I thought was just sort of anachronistic, is kind of where your locations were, where your branch offices were. And I think that's kind of silly in today's world where everyone works from home, or so many people do, particularly in terms of loan originators, and the thought of someone actually dropping by a branch office to complete their application is something from 1966, but not from 2023, where
Sure.
most people are doing them more electronically. So there's to some extent, when I read those cases, it looked like they were anachronistically trying to fit their fact pattern into what was a redlining case from a couple of decades ago. But I think those are all great points still in terms of how you go about it.
They come from the regulators, and again, you know, I bash them sometimes even, but I make fun of them other times. They really want to do good, so they're really after the same thing that the mortgage companies, the banks are after. It's everybody wants to make the world a better place and make loans, because that's how people survive and thrive. And the issue is really with the approach. And so I do think that the background of a lot of the people that are in those regulatory positions they came out of OCC or FDIC or the Fed. And so they just came out of the banking environment, and the banking environment 40, 50 years ago really was, you show up at your local branch, you put on your Sunday best and hope that you get a loan, as opposed to, like you say, Marty, these days it's, there are very few people, percentage-wise anyways, that go into an actual branch. And so when the questions come in from these regulators about how many branches do you have located in these particular communities, the real answer is, who cares? It has nothing to do with reality. But they want to know that, and they see that as, whether you're making an attempt or not.
Troy, you can't get that answer, by the way. I promise you.
I know.
Years.
Okay. Well, we spent a lot of time kind of talking about these kind of guardrail issues here. One of the things I'd like to talk a little bit about is just some more proactive initiative-based programs to address fair lending. Because I think also one of the things that the regulators and others would look at that is very positively, the fact that maybe you don't have branches located in that area, but you certainly have initiatives where you focused attention there. And so I want to talk about what and I'll start with you, Heather, on this one. What do you think is important for a bank or another financial institution to think about in terms of bringing forth more of a proactive initiative to address fair lending in your communities?
And so I do a lot of work in this space. This is kind of I'm in my realm here. So what we've done at the bank is we created a really robust, diverse marketing program. We have billboards up, advertising, from community outreach, sponsoring certain events and things like that. So we've done quite a bit in this space. We also do geofencing. I think that's all very important, but most importantly, I think, is just the community outreach, right? Making sure that those underserved markets are educated in the home buying process.
And Russell, what about you in terms of these kind of initiatives? What do you think is important for the people to consider?
It sounds like Heather's institution and mine are very united in this front. We're a community bank, and we benefit from, and we try to pour the benefits back to the communities that we serve. And so it's boots on the ground. It's understanding what the communities need. It's partnering with all of the Chamber of Commerce and Lions Clubs and nonprofits that tug at your heartstrings and feel like we give back a lot. But a lot of that too, to Heather's point, is that we do financial literacy and first-time home buyer credit score factoring seminars, but it really starts as a nice marketing program with boots on the ground and gathering partners to help support the same cause.
That's great. One thing I wanted to make you all aware of, as well as the folks on that are participating today, is the Texas Department of Savings and Mortgage Lending does have a fund that they have set up that they are doing grants for. You, as members of the industry, to the extent you are licensed by the department, you've actually helped fund that because it's the excess funds that they collect that aren't necessarily necessary for either their operations or to the initial sort of overflow goes to pay borrowers or consumers back that for where they've been wronged and their company that did it is no longer in business, but there's still some additional funds that are there. And the department set this up a couple of years ago. I actually sat on the advisory committee for it. We gave our first sets of grants last year and gave out about $700,000 to various nonprofits to assist with the financial literacy piece of it. We'd love to have more applicants for that. So if you know of some that you're currently working with, I strongly encourage you to let them know about the grant fund because we'd love to hear from them. But in addition to that, if you're looking for people to partner with as boots on the ground, you can go to the Texas Department of Savings and Mortgage Lending website, put in the grant fund, and there is a place for you to find that. Or feel free to send me an email. I'm happy to send you a link to it as well. But I think it's a great way to sort of coordinate that and find people who need the funds, get them out there with it, but also find good partners to help augment your fair lending sort of initiatives out there. Are there specific community partners or nonprofits that you found particularly helpful there, Russell, that you'd like to give a shout out to? I know some people do some stuff with Habitat and some others, and then Heather, I'll give you the opportunity to do the same as well.
We have we're about to do a huge pink luncheon that the bank does every year, for breast cancer month, and it's a huge event. The bank pours in a lot of money and gives 100% of the funds back to local doctors, clinics, those types of things that support underprivileged folks who need those benefits from cancer. Now, what does that have to do with mortgages and banking in general? Well, it's going back to what we were talking about earlier, which is that we support the communities that we're involved in. So a lot of the things that we do, and I don't know about Heather, is it's not related to generating a mortgage loan. It's giving back to communities that give back to us in some form or fashion. And then by that, we earn a reputation of servants' hearts and a great place to do business. So we are able to capitalize off of that. But we also partner with a lot of local churches as well. We're in the process of trying to roll out a program, and I'm going to give you the name of it. Please don't laugh, and if you can think of a better name, please throw it in the chat bar. But right now, it's planned to be "It's Not No, Just Not Now." And basically, we have a lot of folks that apply for loans that, for whatever reason, whether it's credit score or debt to income with interest rates and prices of housing, down payment, they just don't qualify. But we don't want to just throw those folks to the side and not take care of them. And so what we do is by partnering with our local churches, we're able to provide financial literacy and educating customers on credit scores and how to save money for a down payment. And then we partner with them for long-term goal and gain, and we hope that makes an impact.
I think that's great, Russell. I think that one of the things about this, when I think back to, when things were running hot and heavy a couple of years ago, one of the problems I kind of see from a fair lending standpoint, and this was not intentional, it was just there were too few hours in the day. But I think if you had minority borrowers or low to income, moderate income borrowers that were really struggling to qualify, they may have qualified, but it was a harder loan. Then I just think our loan officers, because they were commission based to a large extent, were more focused on the easy, low-hanging fruit, and a lot of people just didn't get served. And by the time we got around to them, the window for them to qualify at the lower rates was kind of beyond them or behind them, and so it became problems. And then now the affordability has become the impediment. So I think finding ways for lenders to work with those people today to get them prepared for when rates do come down and affordability may improve is kind of a key thing from a fair lending standpoint. But it does require people to have some patience and some runway. in terms of that before it's going to bear fruit. And so I think people have to be mindful of that. Heather, what are your thoughts on that in terms of how banks can best navigate that to serve those needs and really serve those borrowers today with the knowing that they may not be able to qualify for a loan for a year or longer based upon the time it takes to improve credit or the time it takes for interest rates to kind of retreat a little bit to improve affordability?
Right, and obviously we have some of those that aren't ready yet. We work with a lot of down payment assistance programs to help those underserved markets, from the city of Houston to T-Shack, we also have, we're a member of Federal Home Loan Bank, and they have their own program called HELP, that, you know, basically if the borrower qualifies, based on household income, the borrower receives $15,000 of assistance, or up to $15,000 of assistance. They just ran out of money. That's the problem with down payment assistance. They all, you know, at times they sort of run out of money. But I really focus a lot of our efforts in that realm. That way, we're all, you know, we're giving the borrower something of substance, right? So we're giving them a way into the property.
That's great. That's great. One thing about working with these kinds of down payment assistance is one you mentioned, and certainly the difficulty of working sometimes with low to moderate income is that they're just more time intensive. And so one question I have is just how do you manage these types of programs and fair lending programs with loan officer comp? Do you see the loan officer comp rules as being an impediment to doing it, or have you found some creative ways that you can make those mesh up where loan officers are motivated to kind of participate in these programs in addition to what they're doing, and just in terms of feeling better about themselves and knowing that they're better serving those communities? Russell, I'll start with you on that one.
So in the past, we actually would pay an additional bonus on loans that closed that were either in a LMI neighborhood or a LMI borrower or a minority majority neighborhood. And so recognizing that those loan amounts are typically smaller, but we wanted to give, you know, a payment opportunity to the loan officer, the same opportunity to make the same kind of money on the loan regardless of what the loan was. And so that was one way that we fought that. And the other thing is that we also added, instead of just paying, you know, a lot of comps are based off of volume only. Well, we added units and volume. So you weren't penalizing a potential loan officer for doing more units, but never hitting those volume markers. So it was one or the other to kind of help equalize everything out.
Troy, do you see any loan officer comp sort of issues with trying to do this on a fair lending basis, and how you might incentivize people?
Yeah, so it comes up a lot actually, and the requirements are somewhat in tension, right? Because on the one hand, you want to incentivize people to, like Russell said, to go out and as I mentioned earlier, sort of cast the net broad and not penalize people for focusing on areas that may be underserved currently. And so there are some ways in the unit-based example that you gave, Russell, is a great one to try to address that issue. I do note that, you know, there are a number of it especially gets touchy in the race context, but also in ethnicity and so on. Anytime you start touching on those issues, either in lending or in employment, you start raising questions about whether you're violating the law in one direction or the other. And we are starting, and it can be super divisive, right? In terms of staff, I mean, even the country as a whole is divided in a lot of ways on these types of issues. And so you really do got to be careful there. And I think the approach that Heather and Russell are taking is quite a good one, where instead of saying we're going to this particular area, we're paying this particular category of person a particular way, it's really just everybody. It's all inclusive. It's not exclusive of anybody, because that really can create some problems. And I think actually some of the recent Supreme Court case with Harvard and North Carolina points out where the legal issues probably are headed. And there's also there's an Amex case that's a class action out there about, they call it reverse discrimination, but it's, you know, discrimination is discrimination, right? It's, if you discriminate against somebody, it's illegal often. And so, you know, you do got to be careful about that sort of thing. But if you take a very broad brush, I think you can get over some of that. And that's true in the yellow comp scenario too.
Okay. One other question I wanted to kind of get your thoughts on, Troy. We mentioned faith-based sort of churches and working with them. Do you see any sort of fair lending risks potentially with utilizing those kinds, just given that religion is one of the prohibited bases that in the fair lending laws that you have to be mindful of? And do you have any best practices if people are engaging with churches, how they might mitigate that risk?
So I think it's similar for mitigation of risk. I think it's kind of similar for, you know, if you have outreach to any and everyone, you're probably doing yourself good. Not to mention you get more loans, which is always helpful, right? And
I think you probably want to have something out there that sort of says that although we're happy to affiliate with whatever religious organization, that you're open to others. So if there's other religions that you'd be happy to set up a similar program with or something like that.
Yeah, that's right. And I will say also that religion these days, now in the past it's been highly charged, but at the moment it's much further down the list of priorities that the regulators are looking for typically. Now, if you have some blatant discrimination, then it'll be a real problem. But most of the time these days, it's not really focused on religion. It's primarily the regulators are looking at race, ethnicity, and then to some degree disability or gender.
Okay. We're kind of moving toward the end here, so I have just a couple of more questions that I want to get people's thoughts on before we open up to the floor. The first one is with the growing emphasis on digital lending platforms, how can the industry ensure that technology-driven processes maintain fairness and do not inadvertently perpetuate biases? I think this is a really important question because if you listen to Director Chopra from the CFPB, he's very concerned that some of the black box, if you will, has biases built into it in some ways, and that he thinks you could have digital redlining that might even be more dangerous than doing it manually in some ways. So I'd like to get your thoughts. I'll start with you, Russell, on how we can deal with that from a digital standpoint and how y'all manage that risk on your end.
I think this one is going to be really interesting over the next few years, especially as technology gains are finally introduced into our industry. And I think simplistically saying, it goes back to that old saying, you can't manage what you don't monitor. And so although we do want to take advantage of, you know, the digital lending platforms and so on and so forth, you got to manage and manage and monitor the outputs of those. And so I do think that there's going to be an opportunity for some of our vendor partners as well. I think some of the technology suppliers will figure out a way to keep that balanced, and then utilizing your internal and external auditors to make sure that there's no misses involved. So as of right now, I think that's kind of where we're going with it, but I'd certainly be glad to hear, you know, Heather's probably way smarter than I am in this area, and I'm here to learn as well.
Heather, off to you. What do you think about this?
Well, you know, my thoughts align with Russell's. You know, one important thing as we're talking about AI, we can't forget about the human element in the loans, right? And the origination piece. So that's why it's so critical that we have this ongoing training with our staff to create this awareness for any potential fair lending issues, because they're going to be our first line of defense when, you know, if AI does have some particular bias, they'll be able to, you know, help us identify that and address those issues as they come.
I do think that those are great points. I think that two areas that I would suggest as kind of best practices. One is have it part of your fair lending policies and procedures that we need to be mindful of, that even though we're using something electronic, that we need to be monitoring that to ensure there's not bias there as well. So you have it just part of your stated policy, which shows it's at the forefront of your mind. And then the other thing I think is part of your vendor management and that vetting of those vendors, that you have questions with respect to that as well, of what have they done to ensure there's no bias in there, that at least you've asked those questions, because I think on the vendor management side, you're just responsible for what those people do as well. So I think that's important to see. Two last questions I wanted to kind of talk about. One of the areas that received a lot of attention lately relates to appraisal discrimination, and you have the PAVE program, which is kind of a multi-agency initiative, and what that stands for is Plan to Advance Property Appraisal and Valuation Equity. PAVE is what's used for short. So I wanted to kind of, and I'll start with you on this, Heather. What do you do to make sure, well, let me ask this way. Have you made any changes to what you do from an appraisal management standpoint to make sure that there's not any kind of biases in appraisals? And what do you do in terms of the appraisal review process, particularly on denials, with respect to ensuring there's not some disparate impact as it might impact minority borrowers in that respect?
So, as I mentioned at the beginning, I made some changes to our error policy last year as a result of the study that the agencies did, that where they identified that there was appraisal bias and it did exist. I did go to all of our AMCs. We currently have 3 of them that we work with, and get their own compliance policies in terms of how they look at appraisal bias, what they're doing on their end to address any potential appraisal bias.
Russell, what are your thoughts on that? Those are great points, Heather. I appreciate that.
Yeah, I actually get to ride on Heather's coattails on this particular question. Thank you for that, Heather. We pretty much do the same thing. We don't utilize 3 AMCs. We do utilize 1, and we took all the steps involved that Heather eloquently described. We did update our reconsideration of value portion of our appraisal management policy, and I think that's important, especially based off of the lawsuits that have recently happened. And so making sure that our folks know, if a customer does have an issue with their value, what the steps are to take, and we added that as part of our training program as well.
Yeah, those are great points, and one of the things I would encourage you to do is make sure that your loan officers know exactly what that policy is. One of the things in the Loan Depot appraisal case that was unfortunate is the loan officer, and I don't necessarily think there was anything intentional with respect to this, but he stated they had 10 days to submit a request for reconsideration when the actual policy gave the borrower 60. So making sure that it mirrors and that they're properly trained on that's a very important point. One other thing, I mean, we've talked a little bit about people working from home. One of the things I know is obviously pandemic has made that much more of a prevalent thing. Have you done anything differently in terms of how you're managing your people to make sure that fair lending is all your policies and procedures are being obeyed and are at the forefront of their minds when they're working remotely? And I don't know, you may not have remote loan officers, so it may not be a big issue, but I thought I would ask that question and see if there's anything differently you think you need to do based upon that. And I'd like to get Troy's thoughts on that as well. Start with Russell, I'm sorry.
Yeah, okay.
So I think we have really good checks and balances, and I don't think that geography or office location really plays that much into our checks and balances. It could be the office next door or the person working remotely across the city. We just put in really good checks and balances, do a great job of managing and monitoring those, rely on our internal and external audits to make sure that we're all playing fair as it relates to fair lending and CRA.
What about you, Heather? I'm sorry.
So for us, I kind of managed to my pre-funding and post-closing quality control reviews to make sure that my staff is adhering to all our policies, procedures, and underwriting guidelines. I'm the one who does the rebuttals for our for our QC vendors. And so I'm directly in the trenches in terms of identifying and addressing any potential issues that I see.
Great. One thing that we talked a minute ago about one of the fair lending cases having to do with the builder-owned mortgage company. One of the things they had there is a lot of personal emails that were sort of in the business email. So I think one risk that you run with people working remotely is they fail to see that the business email is only for business, and it tends to bleed together, and that can be dangerous if they have extraneous stuff that could come back to haunt them that may not be things that you would want at all. And if they were in their office, they would see that's a problem, but when they're home, they may not. So a reminder that people need to keep their home email and their business email completely separate so that they don't end up with something unfortunate is that they may just have forgotten about or get something from a friend who shouldn't be sending it as well. So that's something that we saw. Last question I have is we did start talking about the CRA earlier. One of the things that Jerome Powell recently said is he's advocated for the application of the CRA to non-banks as well as banks. And what he said, basically, it's the same kinds of transactions they're engaged in. Why shouldn't you have the same regulation? We do have 3 states, New York, Illinois, and Massachusetts, that do have a CRA that applies to independent mortgage banks. I wanted to get your thoughts first, Troy, on whether or not you think it's appropriate to expand the CRA to non-banks. I think the big thing right now that they focused on is the market share that non-banks have right now is something like north of 60%. And so if you have 60% of the market that's not subject to it, is that a basis for seeking its expansion? What are your thoughts on it?
So I think the concept of the CRA as a general matter, like where we started out in the conversation here of less of a focus on these hot sensitive issues of specifically race and ethnicity and the like, and a broader focus on just people that may need people who need loans regardless of whatever their particular categories are, actually helps in some ways. I do think that the approach that is being proposed probably has a lot of unintended consequences, and people are they as we talked about with regard to just in terms of where the branches are located as an example, business doesn't operate the way that it used to 30, 40, 50 years ago. And so a refreshed type of a CRA, which they do have some proposals out there to refresh CRA anyways, but a refreshed sort of rethinking of those policies is already in the works and could be something that IMBs could be amenable to, and could actually create some cover, I think, for IMBs who want to help but are worried about getting sued by whatever particular person takes issue with them. But I do think as always, the unintended consequences of a large shift is probably unknowable and probably pretty traumatic and disruptive.
Yeah, that's my take as well. As I think that overall, it's not really necessary to level the playing field because the IMBs don't have deposits to reinvest anywhere fundamentally first. Right. And then I think if you look, I know the MBA, the National MBA, has some studies that they've done in terms of looking at how IMBs serve those underserved areas compared to depositories, and actually in virtually every state, they're no worse than, and in most cases slightly better than what the depositories have done. So there may not be as a compelling case for that expansion as some people would like us to believe. Right. Well, I think we are close to the end of the hour. So I think, Carol, with that, I'd like to turn it over to you for any questions that we have. First, let me thank our panelists today for being here. We very, very much appreciate everything that you've been able to share with us today. I think it's been a great discussion. Carol, did we have any questions in the queue that we need to address before we sign off today? No questions, it sounds like. Well, thank you all for your time and for sharing your knowledge with us. We appreciate all of your attendees spending time with us as well. The TMBA is working very hard to bring these kinds of webinars together for you, so we appreciate your feedback on those. Please check out the homepage at texasmba.org for the upcoming schedule, and watch for emails from the TMBA with reminding you to register. Thanks everyone for your time. Try to stay cool out there. It's going to be a bruiser here in Texas and I think throughout the state, but we hope you have a great day today, and we look forward to seeing you soon again on one of these great webinars that the TMBA puts on. Thanks again for everyone. We appreciate your time today.
Thank you.
Thank you, everybody.
Everyone.